Roundup. What's going on, everybody? It's your boy Kid in the house. Co-host, we got Pit Munch here. We got the special request from Michael. Wanting to see what's going on with everybody. How you guys are doing. How you are tapping into the mentorship, into the latest and greatest. I right now literally have the market on close macro in the ICT Price Action Chronicles on my chart right now as we speak. So yeah, anyway, thank you all for being here. Go ahead and request the speaker tag if you'd like. If you've listened to and or watched any of the 2026 ICT mentorship on YouTube, the idea will be to get feedback from you on what you've learned. And we'll get Michael in here soon enough, I'm sure, with a flood of folks. But in the meantime, Pit Munch, how you doing? There he is.
Yeah, I was gonna comment on Michael's post, but he's already here.
Yeah, he's here. We'll get the wave of folks. And we could even maybe start with you. And I mean, I sent you both tags, Michael. So co-host tag and just a regular old speaker tag.
Well, it's
So
nice to have a surprise space like this. I like it.
oh yeah, it feels great actually.
Yeah.
So I mean, I know he wants to hear from folks and the lecture. I've got the speaker tag out to him. Uh, there, there we go.
Yes, there he is. Hello.
How you doing, sir?
Oh, I'm doing well. I feel a little bit better. Not quite there, about 60% back. But maybe I just needed to get on air and rant a little bit. I got an hour and 25 minutes of stuff coming towards you. It's still compressing and rendering, but we'll see. You guys can get it started. I'm still working in the background, getting things together to post it to YouTube when it's ready. But I just want to hear how everybody's getting along and what they encountered this week. Once I get it uploaded, I'll come in and jawbone with y'all.
All right, sounds great. Sounds great.
Nice.
Absolutely. So, Pit Munch, do you want to start off the conversation at all? Maybe any of the notes or note taking, anything that you've kind of taken or absorbed from some of the latest and greatest?
Well, I was actually in the middle of note taking. It was supposed to be my note taking day, but I'm doing fine. I've had some nice trades lately. Like very, I've posted about it. It's very peaceful, very calm. I've posted about me being a 10 handle trader before, which is a very nice place to start off with. But yeah, recently I have evolved to 200 and 300 handle trades, something that I couldn't even think about like 2 or 3 months ago. And I was already struggling to get like the 20 handles or 50 seemed like such a huge amount. And now I'm just really calm. Instead of taking 20, 25 trades a day, I'm just happy with one and maybe 4 to 5 trades in a week, and I'm done. And I'm just tape reading, annotating, and yeah, it's really peaceful and it's really nice. And I've been implementing the the pre-market range lecture, like annotating the 7 to 9 and then grading that, and then using those octants, projecting forwards to 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 validate PD arrays and key levels, and then taking the trades off of those. And it has been awesome. I've been posting them, trying to put some annotations on it without making it too crowdy, to show people like what the reason was for me to take that trade. And inside of that, I have been implementing like the additional details, the additional how do you call that? The additional refinements of the
Nuance. I
validating.
think I think
Yeah,
nuance is a good
nuance.
word.
Yeah. Nuances for the validating of the key levels and the PD arrays. Like in the recent lectures, Michael showed us that um, we don't have to just look at the actual. If we're going to look at a fair value gap, a BISI or CIBI, um, we don't only look at the actual fair value gap being on the key level. It can also just be the candle itself. So it doesn't have to be on the actual fair value gap. And in another lecture, I think after that, he he demonstrated that if there's a volume imbalance, it can be also the candle prior to that. If that's on a key level, you can validate it like that as well. So I've been enjoying that a lot. Those lectures were amazing, and I've been implementing them. And I have been having like these huge runners, 200, 300 handles, and I'm very peaceful in my trading right now.
I want to pounce on this because I think that a lot of my students, they start very, very small and humble, like you were mentioning, 10 handles. You can get rich with 10 handles. Let's not be obtuse about it. It's literally something that you should strive for in the beginning. But if you could spend a couple minutes, just briefly explain what it felt like while you were still working through that period of only doing 10 handles and not imagining anything larger like you're able to do now, and how did that transition happen for you? Like, what were the things that you started implementing? What were some of the things you stopped utilizing maybe from the stuff that I taught and maybe focus more on very specific things? Or maybe it was something you brought to it even on your own. What were the things that led to that transition? I have one more question after that. When you answer this, if you don't mind, please.
Okay, I think it was several things. Well, how I felt about the 10 handles, I completely co-sign, agree with what you're saying. Like 10 handles is you can really trade and do really well with that. And I actually did that because that's what you were teaching when I started. And when I started, that seemed like a challenge because I would get out at 5 on NQ, and while you were telling us to do 10. But that was in 2023, and we're in 2026, so naturally I'm going to try to evolve and grow. But I was happy with the 10 handles and the multiple trades that I was taking because I was profitable. But the difference with now is that it takes a lot of I have like more bandwidth. It's less stressful, and it's the word that keeps coming up is peaceful. And I'm taking just less trades, and it's just like I'm seeing the setup, and then I'm trusting it. Maybe that's one of the key elements of it. When I was still trading like multiple trades, I was like still kind of doubting, like, okay, I know my analysis is right. I'm doing what I have to do, but I'm still like ready to jump out, ready to leave. One of the things that I changed was while I was doing my water fast. I did a 21-day water fast, and in the last week of that, I was just ready to be done with it, and I knew I shouldn't be taking big trades or doing some crazy stuff. So what I did is I referred back to one of your lectures from 2026 about doing like small drills. And I dedicated that week into just taking one micro and making myself do drills. And I called it to not chicken out. Like, trust the system. It's just one micro. Nothing happens if it if it doesn't go if it goes in drawdown or whatever. It's no big deal. And I started doing that for that whole week, and I started seeing that even though I knew it, I really saw you can just trust the system. Just trust the system, and a retracement in a big run, if the TP is way up there, like 300 or 400 handles, it's just one micro. Don't chicken out. Let it retrace. Whatever. It doesn't matter. And doing that for a whole week with one micro just showed me like I can just sit it out. And then when I went back to trading, to actual trading and instead of those little drills, I was more confident to go through that. while also, like I just said, implementing the new teachings. But I was like, yeah, I'm seeing that it's retracing, but it's not. There's no invalidation for me to not let it run to the TP. So I've seen this for a whole week, so I'm staying in it. I'm not getting out. I'm not going to close it. And besides that, then there's also Kit had a little bit of influence on me with his live streams. I'm also there, and he has been saying things like, for example, he's been very vocal about trading towards midnight. You as well. But he was like, hold it, stay till midnight. And that was also one of my little practices, like watching, nothing complicated, just watch it go to midnight. And that also built some trust, like, okay, it is if you're correct in your direction and you have some of your other stuff as well in place, it's gonna go there. So, and I can trust that. And all of that compounded into me having the confidence and the trust, and then utilizing your new teachings and hold these runners.
That's awesome. And this is what I hear, and I want the students to like pick up on it. Number one, you said there was a couple years between where you first started doing the 10 handles, getting yourself acclimated to executing, getting a baseline, getting a feel for what you're supposed to see, and only expecting to be involved for a short period of time. 10 handles can happen like in a very short period of time. But you gradually moved into it, and you allowed that experience to build, and you used more information. You didn't just go in and try to find one trick pony thing and then say, I figured out how to trade and I'm going to go make lots of money. You allowed the process to take, shape over a period of time, and you gave yourself the time to do so. I didn't hear any of the adverse sides of it. I'm sure there was periods where maybe you were hoping it'd move a little bit sooner for you. And if you did, this isn't my second question, by the way, even though technically it is. I have another question to follow up with this one. But this is so good that I want the listeners to really think about what you're saying. You're saying that you went from starting as a 10 handle trader to now taking down 200 handles. That's respectable. I don't care where you come from or how you trade. I mean, that's fun. Now, that's a real fun number to have. And for you to hear yourself say that, and then think about how it was when you first sat down and say, okay, I'm gonna start putting this to task. I'm gonna try to learn how to do this. What you thought you were going to be able to do or not be able to do versus what you're able to do now, and hearing the words say that you're comfortable. You're comfortable. That's what every student comes to me with. Every single person comes to me and they think, I need that secret response to me. Give me the shortcut answer to being comfortable. How are you able to be in here and just be so calm when you're taking these trades? Or why are you so comfortable giving these types of things where the market should go there and it goes there? You're exhibiting it right here. You're living that. You're doing that. And you didn't get there because it was a shortcut. You didn't get there because it was a real easy thing. You, as a trader, as a student learning from me, and it's not just simply me either. If you go and you learn anything, you get prescribed a routine, a process. And then you have yourself as the unique application in motion with this idea, these implemented ideas that you yourself as the operator or the driver of it, you're like a neuron. A neuron is what we have in our brains constantly. They're like little synapses, they fire off, and they have now recorded these things actively seeking connections. And you can pull it up in a video kit if you're listening. Try to Google a search on YouTube for these little clips of neurons literally reaching out with their tentacles, trying to find a connection. Okay, that's what you are as a trader. You have a model, you have a little bit of experience, but there's other things to learn that's going to make you stronger, and you're going to build a bigger, stronger connection. And you are all like neurons. And in the beginning, when you started talking about the 10 handles, I remember when I first started, I just wanted to get a little bit of movement, just a little bit of movement in the bond market. And if I could get that would be a huge reward. And then it became easy. And then it became, well, let me Let me try to do a little bit more beyond that and a little bit more. And you keep pressing yourself outside the comfort boundaries. And what you discover is what you were fearful of when you first began, or you think that you were never going to get there at any time soon. You stop thinking about I gotta get it by this time. I gotta reach it by this deadline, this scheduled arrival at success. You're never going to be at that because no matter how much money you make, you're going to realize as a trader, there's things that you can refine that make you better. So you're never really arriving at success to the degree where you're going to be satisfied. But in the beginning, you think there's a shortcut to get to that destination. It never is arrived at. You're always going to want to improve. And that's what you should be striving for all the time, always trying to improve. I want to improve my exits. But I loved how you said that you started at 10 handles and you graduated over time using more information. That means you continuously studied, you practiced, you did things, you did the drills. So many students come to me and say, I'm losing money. And I ask them all the time, how much back testing, how much time did you do just in the drill work? Silence, radio silence, nothing. Well, what there's your answer. If you're coming into this and you want to learn how to do it well, I mean, you're competing with the smartest, most ruthless people in a rigged organization, a Ponzi scheme that nobody's really designed to make money but them. And you think that you're going to walk in here and just, well, I feel like I'm smart enough to do this. That's not going to help you here. You have to think differently, and you have to condition yourself in a way where you allow for slow rewards in the beginning. And slow rewards doesn't feel comfortable. It feels like it isn't worth it. But I can tell you this much. Everybody, and you're a testimony to this, but much, everybody that puts their nose to the grind and says, I'm just going to follow the logic and see where it takes me. And to hear you say that you're able to do these things now, and the adjectives of I'm comfortable. When I heard that, I said, okay, I got to jump on that. Because think about it. All of you that are listening, and especially in the Trader Roundup, we all come here like Fight Club, and we say, this is what I had to wrestle with this week. This is what I'm dealing with right now. Or this is how I overcame something this week. And it's wonderful to hear that. But all of you that are still brand new and you haven't found your way, you're all looking for that comfort level she's describing. You're all looking for that. That's the goal, is to be comfortable in your own skin as the trader, using what you know, and accepting the fact that you're going to follow through with continuously refining your craft, getting better at things, reducing some things that you're worrying about all the time, because we're always worrying about something. I want my exits to be better. I've been doing this for 33 years. It should be better than this. That's where my area of importance lies for improvement for me. All of you are going to have the same thing in the beginning, though. You want to be comfortable doing it. You're not fearful. You're not second guessing what it is you're supposed to be doing. What do I look for? All those things are normal in the beginning. But as you go through the content, many people just want to avoid going through that mountainous compendium. But all those things, and I talk about this today in the video, if you don't go through it, you're probably leaving out that one little connection, like that neuron that's constantly seeking a connection. This one little thing. I have so many testimonies from hundreds of thousands of people all around the world that literally come in and they say, I struggled with this and this and this and this and this. And it wasn't until I looked at a video I already watched before. I already watched this video, but I just felt like I had to watch it again. And I got to this video, and at this specific minute marker, you talked about how this is what you shouldn't be worried about, and then only focus on that right now. And that's exactly what I was not doing. I was worrying about something that I had no control over instead of worrying about the information and is it repeating? Is this thing happening? And they didn't do it. And then when they started doing that, it completely unlocked. They had a connection like the neuron. It reaches out with its tentacles. Your understanding, your experience is dynamic. It's seeking more information to shore up its premise. And you, over the period of a couple years, have transformed from the average starting in a drill mechanism to do 200 handles and hearing you discuss it in terms that, I'm comfortable doing it. That is awesome. That is awesome. And more people need to understand that it's not going to happen overnight. You didn't describe something happening overnight. You sound like you have a process. You went through, you submitted yourself to the time. You submitted yourself to the idea that if I keep doing this, I should see a graduated learning curve that slopes up. And when that goes up, that means your comfort level is going to go up. That means your anxiety, your fear of missing moves, whether you are doing good enough compared to the next person. I didn't hear you say anything about somebody else's results. I heard you say, I tapped into Kit. I tapped into the new resources. You're here all the time. You're actually involved. You're not a passive viewer. And there's too many people that come into our community and they just walk through and they're just real casual about it. They say, well, let me see if there's anything interesting there. And if it ain't easy, I ain't bothering with it. Good. Go do something else. But the people that stay here and they put their nose to the grind and really say, I'm going to give it everything I got. And I'm going to enjoy the process. And I'm seeking comfort. I want to be comfortable in the trades. I want to be comfortable seeking my model. I want to know what I'm looking for. I'm not going to be fearful of the outcome, because even if I get it wrong, and you were talking like this, if I get it wrong, it's not a big deal. Why? Because you took away the offensive weapon that you give fear in the beginning. I don't want to lose a lot of money. Okay, don't risk a lot of money. Well, how are you going to argue against that? You can't, because you want to over leverage as a new trader, because you want to get through it fast. You know that you don't have the skill, so you want to have a lottery win in the beginning and say, okay, if I make a lot of money, I'll just be content with that. You won't be if you win. You won't be. I just really pounce on that because I thought that was a wonderful way to open up today. I think it's a wonderful benchmark for everybody to see that it will happen, but you cannot demand that it happens right away. So I want to thank you for that. My other question, this is my real technical second question. You have disclosed this in a space, so please forgive me if I feel like I'm airing your private business out there. But you said you were a lawyer. Am I correct in that?
Yes.
In your own hands, okay, do you as a lawyer see more than what would be required for the burden of proof whether these concepts are valid, if they have any sustainability, if there's any valid logic that tends to repeat? Do you, lens of you as a lawyer, do you see something that you would represent in a court saying, I've seen this happen. I could be a testimony as a witness of it. I've back tested it. I've weighed it out. I've measured it. I put it through the ringer. It either doesn't work or it does work. What would you say in the capacity as a lawyer?
I would say that it does, because there's logic to it. There's proof. It's measurable. It repeats. It's not like a one-time phenomenon or once in a while or once whatsoever. There's so many different elements that come together that you can just clearly present. Like the most important one is time. I still till today I'm stunned when I see people saying that there's no algo or that there's no precision, when you have demonstrated so many times, extensively, that how time is working within the market and how we can utilize that. And that alone is already like a huge evidence to what you're saying. And then besides of that, then there's the well, I don't want to call it little things, but the details like you teaching us like how a body should respect a certain level, and then you see that happening precisely. How two candles stop at the same level at the same price point. There's so many details that I could.
Perfect. I just want to jump in here because you said something I was listening for. That as a lawyer, If you had to argue against the algorithm not being real and it was buying and selling pressure, okay, how could you argue against and make a offensive position against the algorithm not being so and it's buying and selling pressure? How could you argue that the buying and selling pressure would agree with the mechanics on how I teach the order flow? The body should do certain things. It should stay in the upper half, okay, if it's bullish, or stay in the lower half if it's bearish. And wicks, you want to see the body's respected consequent encouragement. Like, how would you? I know I'm putting you on the spot, but I mean, think about this next time when, if you can't really do it well, think about that as a lawyer. How would you go at someone, okay, and defend that? Or not really defend it, but go against it.
Like
Say
against
it
it,
doesn't exist.
against it. Well, the quick answer would be that there's instances where it doesn't happen, and if you go back through price, you really want to, you can find periods of time where it's not respecting anything or looking nice and beautiful. But so that could be something that, well, in my eyes, an ignorant person could come up with and say, like, look, here, it's not respecting it. There's no algo, and it's all bullshit. But then you've already countered that because there's manual intervention, and you've also already thought about a high resistance, liquidity runs, and price actions. So all of that is also covered. So if that would be like an attack, then there's already defense enough to defend it against that.
So just like anything else, ambulance chasers, they'll try it. They'll try it in court, but that doesn't mean they're going to succeed. So they can
Yeah.
look like it could look like a supply and demand zone. It could look like an Elliott wave. It could look like the Wyckoff, schematic. It could look like all these things at the casual view. But when you get down to the science of it and say, okay, yeah, there are times the bodies aren't performing as I said, but are the markets underneath a buying and selling programs that should be implemented during that time? If you blend those things together, it fails. It fails. And like I thought about this week. I was driving around, and you came to mind. You sent me an email. I got it. I listened to what you're saying. Thank you very much for that. But
Yeah.
I was driving around thinking, if we did meet, I would want to ask you that. Like, okay, say we're attorneys, and I'm representing a client that says the markets are rigged, and then you have someone saying no, it's buying and selling pressure. Like, how would that be treated in a courtroom setting? And I allowed this opportunity to do that. So it was very entertaining. Number one, two, I wanted people to hear that, because I know a lot of people don't realize that you are a lawyer, and that maybe that argument never came up in their own thought process. But when you start looking at it scientifically, we talk about macros. If the market's bullish, as I teach, what do we collectively as a community think is going to happen in price during that macro? It should start to show signs that it wants to do what? Go higher, reach for buy side liquidity, and stave off the willingness to want to go lower. Well, if you start there and you're already in a bullish market, and you start seeing down close candle support price, every wick that would be the lower portion of the candlestick, its halfway point supporting any drop down and not going any lower than that with the body. All of those are indicative of a bullish order flow. And if you're long, you stay with it because you're on side until you get to some turning point that turns it around and goes the other direction. So when we strip it down to very simple things like this, and you look at your back testing as a brand new student, as someone that's really hadn't spent that much time with this information, if you just start with things just like that, you'll quickly get comfortable with, yeah, there's uncertainty. It's not perfect, but there's a whole lot more things to learn, and you can see immediate feedback that supports the idea that It's not buying and selling pressure random occurrences. There's things that happen, and they tend to be on a time-based delivery. Things happen around a specific time. Things go to a specific pool of liquidity that occurred during a very specific time of the day, or a session, or a day of the week, or a week of the month, or a month of the year. All these things, they coalesce and they come together with a beautiful tapestry of, you're able to see it. When the average person, when they look at a chart, any other school of thought that's outside of our community, they look at price and they look for patterns. They look for something that yields to them an opinion based on somebody else's observations and a crunching of numbers through an indicator that says, here's the output of taking whatever happened over here and saying that that means something in the future. Or looking at inside the candlestick, and they want to see footprint and level 2 data and level 3 data and level 25 data. They want to get all these things and suppose that this how many people executed orders at this price level. And above us, there's this many people interested to buy it or sell it at this level, and vice versa. And somehow you don't see that as gambling. But what I'm saying can't be real, because it can't be that devious to have something artificial that runs around and just fluctuates to predetermined levels. Of course it is. Of course it's absurd to think that. But when you go in and you look for it, because we're not trained in the retail universe through books and other people, it's scoffed at. And I'm okay. I'm okay wearing that clown mask. I'm okay doing that. I'm okay, just like a radio clown. They look silly, but they rarely get the horns, do they? They rarely get the horns. They're just out of the way, just in time. Just out of the way in time, but they're entertaining everyone. They'd always need to know what that bull's going to do before it gets to them. When you go in looking for this, you're going to be shocked at how predictable these things are. But if you never go in and you allow the influence of other people in the industry to tell you, don't do that, it's not like that, and you just assume that, that's got to be the truth. I don't want to be ridiculed by that guy. That guy gets beat up all the time. There's a market maker that's on the stock market floor that literally says that this stuff doesn't happen. But then you watch us collectively as a community say, they're going to take those stops right there and then it's going to go to the buy side, or it's going to take the stops right here and then it's going to go to the sell side. How are we able to predict that? Because we're not leaning on anything else. We're not leaning on any other logic, except for there's going to be manipulation. It's scheduled to happen around this time, so we can time it. So it's time. It's a measurement in time where you're not randomly waiting for something to happen. We don't know when it's going to happen. We don't know when the breakout's going to happen. We're not breakout traders. We're looking for a scientific measurement of a specific response in price action that we already expect to happen. We're anticipating it. We're not surprised. We're not shocked. We're not taken back in a gasp. Where did that come from? Holy smokes! Virginia, look at this. I was sitting there looking at this thing. I don't know what happened. Corn market just went right up there. I don't know where it went from. I don't know. I have no idea. I have no idea where that happened, why it happened. If I could have got that and known that in advance, we could have made so much money. We don't do that. We don't do that. We don't talk like that. How many times have you heard in these gatherings people saying, I was watching price and I was like, where did that come from? Why did that happen? It rarely comes up. Why do you think that happens? Because we're not going in with the preconceived notions that the market should be surprising to us. In the outside of the cult of winning, it seems like we're narcissistic. We're arrogant. Fools because we think we know everything. No, we don't know everything. We don't know everything. And you don't need to know everything. But you start somewhere. You need to start somewhere, and you need to build that baseline of experience over time. How much time? Rest of your life. It doesn't mean it's going to take the rest of your life to get good at it or make money. It just means that you're striving to a lifestyle. You're not going on a short stint where I'm going to go try this out for a little while. If you really want to do this, then put it in your mind that I'm going to turn this into part of my life, and I'm going to sacrifice a part of my time each day, maybe on the weekends too. And look at it, folks that are here listening right now. You're here on a Saturday. The market's not trading. Why are you here? Because you want to be around it. People here are doing something different. You're listening to some goober that's been doing it for 33 years. Sometimes I get it right, right? So you want to know what's it like to get it right? So that way I focus on that. And tell me where you get it wrong so that way I don't do that. And I try to do that as an educator. I try my best to do that. But I come in and like a vampire, I sustain myself with the sustenance of feedback from all of you. I remember, you forget, I remember what it was like when I first started. And I remember what it was like to have these struggles that you're going right now. I don't feel those things anymore. I don't feel it. And when you have these things constantly being an impediment to you in the beginning, you want to find ways to get around it. You want to escape it. You want to avoid it entirely. When that's the biggest learning parts that you're going to have in the beginning, because you're going to have your metal tested. You want to find out what makes you tick, what makes you scared, what gets you hopped up on goofballs where you're excited and you feel like you can do anything and nothing's going to stop you. Those are triggers, and you need to know what sets them off. And then how does that relate to your trading? What do you expect in price action? When you expect something to happen, you expect the fair value gap, the support price, and it doesn't happen, what does it make you feel like? Mad? You want to go into stock account and troll me and say, this stuff doesn't work. I blew my account. I hate you. Go to hell. Or do you like, okay, why did this fail? Because it's failing. Maybe this is about to become an inversion fair value gap. And what I thought was going to happen, I'm wrong. Imagine that. I'm wrong. And now, what if I flip the script? Because I don't have that much experience right now. Let me test it going the other direction now. And where's the sell side at? That's a proper, flexible mindset. That's what's worth teaching. You're teachable. If you're in here constantly looking for something to find fault with and say, oh, it failed here, it failed here, it failed here, and you're ignoring the plethora of witness testimony and other people's hands using it, every single week I'm outlining things, and you see it happening, it's panning out. I don't have 1,000 things I'm talking about in the technicals. It's very specific things. And you see them being implemented using the logic that I teach. That's not random. That's not me guessing. It's me saying, this is where I want you to focus. Focus at these levels and see how the market behaves and what it does to get to those levels and what happens when it gets there. Over time, hanging out with the old man, you will learn things that never were fashioned as a question in your mind when you first started. That's experience. That's you gaining more connections like that neuron. You're constantly being like you're reaching out. I wish I had the video clip. It's a little tiny little clip I saw, and I was like, man, this is really fascinating. It looks like a living organism, like a lightning bolt, okay, that's constantly reaching out to make a connection. And that's you with your model as a trader. You're constantly looking for a connection with new supporting evidence that what you're doing is valid. You're learning what not to do because you're doing it. And you're trying to avoid in the beginning, which is normal, it's natural. You're trying to avoid pain. When pain, loss, missed opportunities, that's where you learn. That's the part of this that you are trying to go through, where there's no risk, where there's no embarrassment. Everybody's on the same playing field. Everybody's on the same playing field when you first start. But somehow in our minds, we think that we have to have it right. We got to do it right the first time and never fail. It doesn't work like that. You want to know what it feels like when you mess up. Because the things that you're thinking, which is where journaling comes in, when you're doing those things, the negative, toxic stuff, you're cussing yourself out. punishing yourself for exploring your limitations. And said, listen, I'm going to go up here. I'm going to try to swing the bat hardest I've ever done it before. And you swing and you miss. And the other team laughs at you. And you go to your parent. And then the parent's going to do what? You stupid so-and-so. You tried too hard. Why'd you do that? Nobody's going to do that. And you as a parent wouldn't do that. But why is it that we do that in the beginning when we're trying to learn how to trade? Think about it. That's what you're doing. You're punishing yourself for trying. But are you trying consistently with a realistic expectation? Because you can start on the right foot, but then get swayed by people like me and other people online that share their experience. And it may be outside the spec that you're at presently with your experience level. And you think that, man, it should be faster for me to get there. Why? Who said that? You. That's just you wanting to get through the hard part. When the hard part is what makes you the better trader than you could ever imagine. All the difficulty, all the things that you're trying to tiptoe around, that's the very thing that makes you good. That gives you the words like Pittman said, I'm comfortable. How'd she get comfortable? Because she experienced it not working in her own hands. And she saw that, well, while that happens sometimes, it doesn't deter my interest in pursuing it. And over time, she went from 10 handles to over 200 handles. And I'm sure that probably felt like crazy for her to have it happen. And then when it started happening multiple times, come on now, that's a paradigm shift. That's a change in the mindset that you have to experience. Nobody can really articulate it where it means anything to you. It's like, yeah, so, okay, whatever. It doesn't help me. It doesn't put any money in my pocket. So what? You're starting to sound like you're bragging now. No, you're trying to share something with people. Like we're all here together with a common goal. We want to talk about trading. We want to talk about what makes us profitable. How do we get there? What are the things we're going to have to encounter? Why isn't the books filled with that in the beginning of the book? Because you'll take it right back to the cashier and ask for your money back. I didn't want to be bummed out. I bought this book to learn how to make money. This guy's talking about you're going to have to go through all this hardship in the beginning. It's normal. Dude, come on. It sounds like a domestic abuse here. But it's simply a process that you go through. Everybody that joined the military when they were younger thought, man, I'm going to be Rambo. Until they got the basic training. You're making me wake up at what time? What time is this? You're doing what? We got to do what? We got to go where? I got to carry what? Where's breakfast at? That was breakfast? I got to do this for 6 more weeks? What? Yeah. They put you through conditioning that you're uncomfortable with. But at the end of that 6 weeks, you can run circles around people. You could do a whole lot more things than the average person. But you're not thinking that when you're going through it. You didn't think about that before you joined. You're like, well, it's going to be that big of a deal. Everybody goes through it until you were there the first morning. And they're beating that trash can, waking you up. Let's go, ladies. Time to get moving. Let's go. That's the motivation you have to have. You yourself have to do that. Me watching, or you watching one of my videos, or listening to other people in the Traders Roundup, it only goes so far, folks. That only has so much octane until then you're going to have to have it on your own. You got to have your own steam, your own desire. And it's got to be more than, I just want to have more money. You got to believe that you can do this. You have to know that it's for you. And I've never met anybody out there that hasn't had a sincere desire to do this, that it's not deserving for them. It is absolutely deserving. But it filters out all the undeserving. Because if they want it fast, they want it easy, you're not going to make it here. You're not going to make it in anybody else's course either. Because you have unrealistic expectations. The first time you go on the drawdown, you're going to go on tilt. You're going to self-destruct. And if you're lucky enough to find the gumption to go in and put more money in or pay for resets, if you fail then, and family members, a spouse knows about it, you want to crawl under a rock and wish you never started. Guess where you're at? You're at a crossroad. Because if you're a trader, you're going to take that, chew it up, and swallow it and say, this ain't enough to make me stop. It's not enough to make me stop. Sure. I talked a good game. Told my friends and family I'm going to make all this money. But it hasn't happened yet. You have to know beyond a shadow of a doubt that, okay, the back of my mind, I knew this was likely to happen to me, but I didn't think it was going to happen for me. I was hoping it wasn't going to happen for me. But now I'm met with this hardship. I'm at a crossroad. Either I turn around and say, forget it, or I listen to the old man and I say, this is a mile marker. Because if I can get past this, I'll never feel like quitting because I went through drawdown and blew an account. Because you're going to blow an account. You're going to blow it. There's never been a trader ever that came out there and just skyrocketed up and never had that happen. It's never happened. And anybody that says that is a bold-faced liar, period. You learn what you're made of when you go through that. And there are certain things that you can avoid repeating that dozens of times, but it requires you to take inventory on yourself. And the ones that keep repeating that over and over again, the two main culprits, and I'm going to say this and I'll open up for everybody else because I got to get this video up on YouTube. But the two main culprits are, number one, rushing before you really know what you're doing. Because just because you want to make money, just because you want to sit in front of these charts and you want to click buttons and watch candlesticks go up and down, you think you're going to go to a relative equal high or relative equal low, and you think that's all there is to it. Just give me a fair value gap in the middle, baby. I got it. I got it from here, ICT. Don't worry about it. Go rest until you try it. You're like, oh, man, I didn't realize it would be like that now. I mean, where'd this come from? Like, I wasn't expecting this thing. And he's over here talking about he shorted it, and I'm been trying to go long. Yeah, this is cat. This guy's full of crap, man. Come on, this is all made up. This is bull crap. You got to take inventory. How soon did you try doing what you thought you understood? I know it's expensive. You don't want to do it. You don't want to admit that you did something in a rush. We all do that. We all do that. You think you're going to be the exception to the rule. And the sooner you experience that and get through it, the better. Just break the ice, get out there, and just discover that you're not ready. Get it out of the way. Just get it out of the way. But you don't need to keep repeating that. But once you get to that crossroad and say, okay, now I know what he means. So now let's be a little bit more mature about it, be more responsible about it, and say, I'm going to make this a business. That means you're going to have to put some effort in it. That means you're going to have to work on weekends. That means you're going to have to work for free for a long time building it up. Then over time, like Pip Munch said, a couple years now, she's reaping the benefits and the comfort, key word there, comfort of being able to do 200 handle runs. Not worrying about, oh, I just want to do five trades a week. Some of you want to do that in the first 2 hours of trading, and you haven't even traded 6 months yet. That's not realistic. And these are the things I talk about that makes me an unpopular teacher, because there's a lot of grooming that you have to put yourself through. You have to prune bad things and make observations about yourself that's going to reveal ugliness in you, character flaws. And if you don't master them, if you don't wrestle them into submission and get them out of your thought process, they're gonna hold you back. I don't care what you trade with. I don't care if the best trader out there in the world is willing to sit right next to you. You will still lose money when you try to do what they teach you, because you have toxic mindset. You're impulsive, you're impatient, you think it's never going to happen to you. Because you never put yourself in a situation to encounter that and work through that. Drawdown, that's a wonderful thing for you to go through. It's wonderful because it teaches you that you have to be responsible with your money. You have to be responsible with that money, because if that's all you ever can put into an account, what are you left with? No other choice. That's it. So you have to be a good money manager. And by going through drawdown and blowing an account, man, that's the best lesson you can have from that. You can't learn it any other way. Oh, I don't want to lose any money. That's the same for someone else that's blown their account and has to work Domino's Pizza just to get money over a couple months, just to put more money back into the account. It humbles you. It gives you a sense of purpose. It slows your roll. And these are all good things, but it doesn't sound good. It doesn't sound like a good marketing campaign to make people want to join what you're trying to pursue. And the other thing is, you don't have a model. So many of you just flirt with things. Yeah, I'll use an order block. I like order blocks. Okay, what's an order block? Oh, it's the last candle. No, it's not that. As soon as you say that, that's not what an order block is. So you haven't spent enough time doing anything. You're just dabbling. So you're just waiting for something to just happen in your hands, and then that's going to be the source of motivation. And then you contrast it with everybody that comes here that says, I've been working on this, I've been grinding through this, I had some adversities here, but now this is what I'm doing now, and I'm just so thankful that I just stuck with it because now I'm doing something that I couldn't imagine before. Like, I'm going to be listening to Pit Munch in my head now for about 3 weeks. Those are the things, when I hear those types of things, they put me over the moon because that's exactly what I'm trying to talk to you about. That's the motivation. That's the thing I tell you to go through. Go through it. It doesn't feel like it's going to happen fast enough for you. It feels like it's taking forever. It's never going to happen for me until it does. And then all the things you weighted yourself down with, all the self-doubt, all of the misery that you bathed in every single day saying it should have happened for me sooner. Nobody's worked harder than me. Nobody's done more back testing than me. Come on, man. Come on, stop that. If you start thinking that way, that's a telltale sign you haven't done enough. This guy's talking about I didn't back test. Look at my notes. Scribble. Scribble. I want to know what you've been doing with the information you've been collecting. Don't just write down, oh, I would have done this. And how much of that is that happening in the past? Not just what you just wrote down. Study it. See if it's happening. See if these macros are real. See if that 20-minute window isn't calling the highs and lows intraday of every single day, every single week, of every single month. Do that. Just do that. Pull up your 5-minute chart, spread it across your chart, and go at every intermediate term or long-term high. Sometimes it'll be short-term highs and lows. But they're turning inside that 20-minute window. Look here. That's how it happened for me. That's how it happened for me. And I'm like, wow, there's something to that. Let me start blending market structure with this. And let me blend some other things when I think it's going to go higher because it's supporting everything underneath it. What if I start just doing buy signals just in the 20-minute window of that? And then I started seeing rocket fuel longs. Boom! The first time it's going to be, wow, what just happened? It's like you just captured lightning and put it in a bottle. But now you got that bottle anytime you want. Every hour it fills up again. Every hour it fills up again. Every strike isn't as potent as the one before it. But when you have all things come together, when all things come together, you can catch lightning in a bottle. You don't have to purchase it. You don't have to buy bells and whistles to be able to see it. You can anticipate it. It's going to happen in that little 20-minute window. You're getting the close of the past hour and the first 10 minutes of the new hour. It's a rush to finish up orders and bring in new orders. And it's not the buying and selling pressure. It's the momentum and movement that those orders will be able to be permitted to be filled in. It's not driving the price. The buying and selling is not driving the price. It's permitting it to ladder and chase it as it runs. That's exactly what's happening. So anyway, I had a lot of pent up energy today. She excited me when she said what she said, and I just want to tap into that. And I feel so blessed. I'm glad I called for you to start this up, Kit. It was wonderful. I want to hear everybody else, and I got to just sit here and listen to all you now. I'm excited.
Rock on. Sounds great. Um, Anything else, Pit Munch? Did you want to add anything? Just because, I mean, it was kind of coming all your way. Just wrap up with you one final thing, if at all. And then, I mean, Mike was asked that we continue the conversation, so we will. So
Yeah.
I was just going to let you put a bow around it. That's it.
Well, maybe the little bow is what he's saying. Like, it doesn't come in one day or in a few weeks or in 1 month or whatever rush anyone is feeling. And I just want to really um, enforce that and also make clear that I was actually in a critical situation where I would be wanting for it to be fast because I lost my career due to health problems. So naturally, I would have wanted it to be like, okay, in 2 weeks, I'm doing this. But I realized that's not what this is. This is not some little course somewhere. And the point that I want to make is the YouTube channel. Um, it's not. Don't look at it as a bunch of playlists or a millions of videos. Look at it as a university. We've spoken about this in prior spaces, but the YouTube channel it's a compendium. It's a whole university, and that's how I have been approaching it, similar to law school. You're not going to learn everything in 2 months or in the first 6 months or in the first year. You're not going to go through law school in just 1 year. You can't. And you're going to do a master's. So that's how you should approach the YouTube channel. And that's how I still approach it. And when he uploads new lectures, in a recent lecture, he said the logic isn't changing. And I just want to reinforce that it is true. The logic isn't changing. My trading and the way what I see jumping out of the chart, it's not like it's something different than what I was seeing before. When I was doing the 10 handles, I was already seeing mostly accumulation, manipulation, expansion, AMD. But I just didn't hold the expansion for a long time, and I needed practice to determine when it would be like a long expansion or just like a like a um, small candle up, and that's it. So now with the 200 and the 300 handles, it's not like I'm doing something completely different. I'm still seeing, and you can see it in my post, in what I'm posting. You see accumulation, manipulation, expansion. I'm still doing the same thing, but there's refinement and added knowledge. So I'm not changing what I'm seeing or what I'm trading. What's happening is that my understanding of the whole market and the teachings, that is growing and that is expanding on top of what I've already been studying and implementing. So it's not like there's constant new things and changing up. So when I'm saying I'm trading now the 7 to 9 pre-market range that he recently taught, it's not like I changed everything. It's just it's refinement to what I was already doing. So, and it takes time. And when I started, I gave myself 5 years because if you go to law school, you do here in Europe, you do 4 years and then you do a master's. So I said, I'm giving myself 5 years to get this with his university on his YouTube. And now we're like 3.5 years in. So that's the bow I want to put on it.
Great way to put a button into that and follow through. Thank you, Pit Munch. Appreciate you. That's just great news. That's wonderful. I love hearing that. I'm fired up too. I can see why, and I understand what Michael's saying because Pit Munch said a lot. And I mean, I want to hear from other folks as well. So I'll leave it there. We'll bring up Gray Eagle Trader. We got Wateria changed your name again. You've been up here before. We'll start with Gray Eagle. You're up, buddy.
Okay, thank you. Hello, everybody. Just a quick protocol. I'm Gray Eagle. My name is Randy. I'm 65 years old, card carrying Medicare member, trading on and off for 40 years, made a bunch of money at times, lost it all every time. I started studying Michael's content in January 25, and I've been literally obsessing with it since then. Can't get enough, love it. I would never want to be a lawyer to try to prove that the algo doesn't exist. I don't know where you'd start. Pip Munch gave it a great try because she's an attorney. I wouldn't know where to start. Um, Uh, First of all, Pit Munch, you're so inspiring. I'm not sure. I know you responded, so I did finally figure out how to get a text out to you on Twitter, whatever it's called. But it's inspiring to hear the battle you've gone through, how you've overcome, and how you're really nailing it. So that's fantastic. Kit, I appreciate what you've taught, and I promised I'm getting to a question about dealing range and what we've learned recently. Kit, you frustrated me a lot because you kept saying core content, and I kept thinking, man, I don't have time. I'm doing these 2 or 3 or 4 hour courses, and then I looked at it after hearing you, I don't know, 50 or 100 times, went back and did that, and that was gold. And you still talk about it, so I appreciate everything you do with the spaces and encouraging people. Every now and then I think I know something, and then I listen to Kit, and I struggle to understand him. I'm understanding more than I used to, but in any case. I've been very inconsistent. Some days I see price action like it's white on a black wall. Other days I struggle and I'm just wrong. And I'm trying to refine what I'm doing. I'm using AI to help me analyze my trades, et cetera, et cetera. But in any case, I want to get to the question so I don't take everybody's time here. When Michael's been teaching recently, you've taught about chain of custody and octants in various periods, and I've loved that. And then what I did, you would hate my chart because I have so much lipstick on it, it's hard to read, but I started looking at a bunch of them. So the 4 to 6 a.m., the NWOG, NDOG, the ORG, the failure value gaps, wicks, and I found all of a sudden that my chart was super crowded, and all of a sudden most of my fair value gaps were laying on an octant because I had so many octants. So my question is there some sort of a hierarchy that we should consider or ponder when we're taking a look at putting octants on higher time frame um, wicks or whatever they might be, so that we can identify when something, a PD array, a fair value gap, or something else lays on an octant? Is there any hierarchy? Because you always seem to just get it right, of course, and I can't figure it out.
Well, you'll be amused with the timing of your question because I spend the majority of the 1 hour and 26 minutes of the lecture that when we're done with this, I'll upload it to YouTube. But I kind of walk through the process. Everything I explained this week, what I was looking for, what levels of liquidity was important, everything I walk through it. Okay, so I get questions all the time. Hey, you talk about what you have written down. You don't need a chart. How's that even possible? I have to refer to a chart initially, but once I have my levels, I can read it just by watching the ticker tape. Like I don't need the chart. I can see the numbers and say, okay, what time is it? Okay, I'm keeping track of the highest high and lowest low. All those things that's happening intraday, I don't need a chart, and I can tell what key levels are being traded to because I already have a measurement. So when we're looking at, and you mentioned it, like you said, what like these dealing ranges, and how do you know when to like not spend so much time on a very specific range and go to a different one? If you're going to be systematic about it, and that's exactly how you should start it, because if you give too much information in the beginning, you'll get information overload and you'll be like a deer in headlights, and that's what I'm trying to avoid. Even though I throw a lot of stuff at you in that paid mentorship content, you got to remember, I was telling them they had to go through 1 year with me. But those lectures are important for you to weigh out through the next year. Just because you're introduced to the idea doesn't mean you know it. And then you have to now start implementing it. Well, when you have, for instance, we'll look at the morning session, okay, in the US. Let's just say that you're worried about only focusing on inside of the 7 a.m. to 9 a.m. that 2 hour pre-market session. The highest high and the lowest low in that range is useful information for the entirety of the opening range during the AM session for regular trading hours. It's useful and salient for the lunch hour, 2 hour window. And if price comes back down into it again or up into it in deference to where it's moving in the PM session, it's useful there too. So it makes perfect sense for you to start there because it's going to be applicable to the trading day for AM session, lunch 2 hours, and then PM session and regular trading hours close. Whatever you're using to frame the logic on, stick to just that in the beginning. You won't catch every move, and it's important for you to experience that because you'll learn to refine your focus on a very specific element of price action. And because of that limited perspective and only focusing on just that for right now until you get good, don't try to ring in other things like, okay, well, now I'm going to do the 30-minute opening range and I'll grade that too, because then you're going to have more information than you need. You don't need that. What you're looking for is one good setup per week. You want to be able to prove that you can find one solid setup per week that you can execute on. That means have a demo account and put something behind it so that we can focus on it. And if you can hit that every single week consistently, not feeling like you're rushing to chase it, you anticipate something happening, you're not going to have a whole lot of things on your chart, will you? You're going to have just this today. This is what I have to deal with today. And what I show you in today's lecture, if you approach it every single week and every single day, just like I'm outlining, it will keep you from having too much information. It'll be very systematic. It's not a whole lot of stuff on your chart. You'll see that chart is not loaded with a lot of things. Everything I shared this week, I explained in great detail as to why it was useful and why I even used it at all. It's not a lot of stuff, but the results of knowing what the weekly high and the weekly low and where they may be and how you can navigate that and what pieces of time-based ranges like the 2-hour window of 7 o'clock to 9 a.m. Eastern time, that little segment of price action. If it's consolidating, it's probably not going to be all that useful to you. But if it has a run where it's trending and it has a real nice defined range where you can see it's definitely had a delivery from a high to a low, and it wasn't just banging around sideways, it's going to be really useful to you when we get into the AM session and lunch hour and PM session, if it shares that same range. But if it is consolidating, then demand that it's the 30 minutes of 9:30 to 10 o'clock. That would be your operating range to then do your grade advance on. So there's your, if it does this, which is if it's trending in the 7 o'clock to 9 o'clock, that range will be used later in the day. If it's consolidating between 7 o'clock and 9 o'clock, then demand that the range that you have between 9:30 and 10 o'clock, grade that out and then project that throughout the rest of the day. Wait for setups to make sense in there in terms of what you expect to see price draw to on a daily chart with some inefficiency that it may trade to, or a key high, a daily high, a weekly high, something that affect relative equal high. You won't get 1,000 trades. And that's not the goal here. The goal is for you to be able to find something like a cookie cutter. You're not having a whole lot of moving parts. You won't have all this bleeding of, like, if you're trying to put the Asian range with all of its potential octants and gradient levels, and then you're looking at London session, and then you're looking at 7 o'clock to 9 o'clock, right away you got too much information on a consolidation day because it's going to lay over top of everything. And this week, what do we have? The consolidation the first part of the week, right?
Yep.
Which is going to be a problem if you're trying to blend all these things together. So know what time you're going to be trying to trade. Whatever, can I ask you what that time of day is when you're trying to trade?
Yeah, it's the first 2 hours AM session. So I'm on the West Coast now, and so the 7 a.m. Eastern is a little early, but I'm getting up to I'm up at I don't know, six or seven, and watching that session. But typically, I'm doing that or the first 2 hours of the AM session.
Okay, let me toss one other little thing in here. Then, if you're focusing on the 7 o'clock and 9 a.m. predominantly for listeners that are doing that, look at the range that formed overnight in London, because that will carry over into the 7 o'clock to 9 o'clock. They'll share that same little bit of information and data. If there isn't useful information from the London session, then there's probably going to be a nice run in the 7 o'clock to 9 o'clock. What do I mean by that? Say London's just banging around, ain't really doing anything. It's consolidated. And it's rare that it happens, but it does happen. If it doesn't run in a very defined price run higher or lower, where you can look and say, okay, this is clearly the highest and the lowest of a very easy price run in hindsight to see it. That's the key. If you can see it clearly in hindsight, that's the one you grade and project in the future. If it's consolidation, if it's banging around, don't do anything with that. Just wait till the new session start. Roll over into 7 o'clock to 9 o'clock, and then wait for it and see if there's any like really clean price level that creates like a little trend inside this 2 hour window. Carry that forward, and it'll be used during 9:30 to 10 o'clock. But if it's ranging in 7 to 9, whether London is trending or consolidation, if it's consolidating between 7 and 9, demand that the dealing range that forms between 9:30 and 10 o'clock, that's where you're going to get your first presented fair value gap. That's going to be where your inversion fair value gaps form based on the octant and gradient levels in there, and you're done by 10:30.
Okay, that's hugely helpful. And then, can I just ask one add-on question? Uh,
Sure.
one of the other things I find that I'm doing is I'm defining premium and discount, and I, Kit talks about that. A lot of people talk about a lot. You teach it a lot, but I find myself, frankly, rationalizing what's premium and discount when I'm looking to push to take a trade. And I'm trying to get better at that. But would I then apply the same range that, once I go through the process you just discussed for identifying premium discount, or would I be looking at a different higher time frame range for premium discount?
You're only attributing whether or not you're in discount or premium relative to your dealing range that you're operating in.
Okay.
You're gonna many times be entering inside that range, so you're trading inside the range, but then you're gonna be targeting external range liquidity most times, and you'll take a partial inside the range. So that way, even if it doesn't escape the range that you graded out, and like say for instance, say you're bullish, and 7 o'clock in the morning, we drop down between 7 o'clock and 9. London session consolidated. It's kind of messy. Hasn't really done anything really eventful. 7 o'clock, 9 o'clock, we traded lower. You're bullish. You see a relative equal high on a 60-minute chart or 15-minute time frame. It's just real juicy. It's likely to get up there. It's got nothing saying that it should go lower. All things equal, it's likely to go there eventually. 7 to 9, it's been going down. Grade that. Okay. And what you're going to end up doing is you're going to grade that out as the sell side of the curve of a market maker buy model. You don't realize it yet when you're brand new, but that's what that becomes. And then the octant and or quadrants, as it trades down below the midpoint of that range, you're considered in a discount market where the first stage and second stage of reaccumulation will occur on that yet to be formed market maker buy model. So you're defining it relative to the dealing range that you're grading out inside of a very specific element of time of 7 o'clock to 9 o'clock. And if it doesn't form a trend that's really clean and discernible between 7 and 9, because sometimes it won't. You'll be in front of the charts waiting for it to happen. It just isn't going to give it to you. So what do? Roll over to 9:30 to 10 o'clock. Submit just that 30 more minutes. And if that doesn't do it, walk. Don't do anything else. Don't trade. See how easy that is? But if it gives you the very discernible trend and you grade that out, and then you start seeing buy side or sell side liquidity pools forming right on the octant or the quadrant levels, and then you project them in the future, use that to get into with your setups relative to whether you're bullish or bearish, and you have it. You're not surprised. You're not confused as to what you're looking for, and you're defining things in terms of discount to premium relative to that range that you're grading out. Forget everything else. That's all you're worried about. That little bit of information. If it's below the halfway point, you're in discount. If it's above it, you're in premium.
Okay, that's fantastic. Okay, and then I presume if I'm doing that correctly, then I'll identify HR high resistance conditions quicker because I've got things defined and I'll see the chop. I guess the question is will that help, or is there an easy way, earlier way, because I'm defining it or identifying it too late, the high resistance condition, the chop that chops me and everybody else up?
Well, think about what I just taught you.
Yeah.
I said that you have to look and see if it's a very easily discernible range for it going down. A market maker buy model doesn't start with high resistance liquidity run conditions.
Right.
And a market maker sell model doesn't start with a high resistance liquidity run. So you're demanding that first half is there. Once it's there, it's in place inside of a small little window of opportunity of time. You've done 80% of the workload right there. So all you have to do if you're bullish, find that equilibrium price point. Okay, that's the midpoint level from the highest high and lowest low, or vice versa. And you're looking for any PD array that lays on an octant or quadrant level as it drops down if it's going lower in that nice little trending movement. It's a little tiny little price swing that'll be so clear. It'll stand out against everything else that's occurred in that little window of opportunity. When it forms, when you carry those levels forward and you project them, like all the fair value gaps, project them over, every sell side imbalance buy side inefficiency will then become, when you're bullish, it will act as an inversion fair value gap. And the first two that form, or say it's a, I don't know, A fair value gap that forms on a quadrant level on the way back up, that could be your first stage accumulation. It could be your low risk entry long. You could, if you're getting better at it over time, you'll be able to nail down the smart money reversal, the very low of the day. And it's usually with some kind of a short term low taken out, where they'll create a low and then go down one more time, and you trade that as a triple soup long. I'm building out for people that are a little bit more advanced than what you're describing, but everything is discernible by you having a very clear visual representation of a trending little price swing that stands out against every bit of price action around it, just inside that 7 o'clock to 9 o'clock window. Same thing during London. Between 2 o'clock and 5 o'clock in the morning, you're looking at that real easy, clear, discernible price run. There's going to be other things that happened around it. You don't care about that. That's the chaff. You're just looking for that real clear little piece of price action. That's the measurement. That's the anchor to high, low of that, and then project that into 7 o'clock and 9 o'clock. And you'll all you gotta do is start back testing it. Your jaw's gonna drop. You're like, what in the hell? It's been like that. It's always like that. It's why it's always easy for me to come out and say, watch this level here. And when I don't see it, I'm not tweeting anything. Why is that? Because it's not there for me. So I sit still. I don't do anything. I'm not putting my reputation on the line. I'm not going to risk any money. I'm not going to have a devo trader loss. I'm not going to have any of these problems because I know what I'm looking for. And I'm letting the market show me it's prepared to do something. Market maker buy and sell models. Okay. This is what Wyckoff doesn't teach this now. They don't start with high resistance liquidity run conditions. They initially give you low resistance. That means you're going to have gaps that stay open, and they respect it in the way they should based on what I'm teaching. If it's a sell side imbalance, buy side inefficiency, we don't want to see it completely close in. We want to see the upper half of it stay open. Nobody's in the upper half. It can wick to it, but leave something open, and then it continuously goes lower. Wonderful. That's a range that you can project to the future, and everything that was used to go down will be used as a stair stepping going on up. Simple, simple.
Wow, fantastic. Okay, thank you, Michael. Kit and Pit Munch, again, thanks for all you do on the roundup, and Michael, thanks for sharing this gift. I have to say thank you. So appreciate it.
Awesome. My pleasure.
Wow. Wow. What a great class, Michael. Really is good. You're amped up today. So it's good to see. I mean, I just want the listener to understand these FEGs, these fair value gaps, these directional inefficiencies that are occurring at specific times. It's up to you to really track and monitor which one of these inefficiencies you care about and that you're going to anchor towards within the compendium and the logic that Michael presents to you through the mentorship and core content. So I just think it's really important that the directional inefficiency that you're choosing within your market maker, that you anchor to that and trade that, right? And referring it to as directional inefficiency is kind of an academic way of referring to the classic ICT FEG, right? Anyway, we got Pippi Banks of Charter here. We heard from Gray Eagle. We got Water Warteria Agency. And then, Michael, how are we doing on time today?
Extraction time, 1 hour from now, 3 p.m.
Okay, beautiful. So, Pippi Banks, you're up next, and then we'll work our way around the room. A little charter recall on the charter. I got you, Watering Agency. You changed your name.
I'm actually Andre. No, I'm Andre.
I know who
Yeah,
you are. You have
I
the
actually
same
didn't change the name,
picture,
but
but
anyway, it's fine. Anyway, it's
well,
fine. Happy,
anyway, yeah, we'll come to you in
happy
just
Charter Day to everybody.
1 second, buddy. Pippi Banks Charter. I like giving some of the charter. Well, he's my friend. That's why. Anyway, Pippi Banks, you're up next, buddy.
Okay.
Yo, y'all hear me?
Yes,
Yeah.
sir.
Hey, what's up? How we doing?
Pretty good. How about yourself, buddy?
I'm good. I'm good. I'm good. All right. So I have a question in regards to the PD array of the breaker, right? Now, I've been going over a lot of, I'm going to say more recent content because I didn't really follow up after like 2024, 2025, right? So I'm I'm dialing back on that, catching up. And I see that you have these attaching PD arrays that attach to the breaker, right? Sort of like the Reaper and what's the other one? There's another one. It came out in 2024.
With my juice.
Venom,
No, not Venom.
the
Is it
Modus.
the
My juice.
Madus? Yeah, I think
Modus
it
is
is.
connected to a breaker, so yeah.
Yes. So one is on one leg of the breaker, right? The fair value gap on one leg, and one is the fair value gap on the other leg, right? Is there any connection if you have two fair value gaps overlap inside that breaker, right? Does that, like, how do you know which one to actually trust if there's both fair value gaps presenting themselves inside that breaker? So one is presenting itself on the first leg and one is presenting itself on the second leg.
It gets back to first, do you know where your market's going to go to? Where's it drawing? And the concept is, because it's a breaker, it's purging liquidity. So you have to know how far it can go beyond the boundary of the low or high you're expecting it to sweep. I'm going to personally, if I got both giving me a fair value gap, I'm probably going to be entering and utilizing them both as means of getting in or adding partials to it and building the position up. So that's a win-win for me if I see two of them. Madus and Reaper, both of those, they don't always form together, but when one forms, I'll take the higher one. So whatever one's higher, I'll use that in reference. If I'm bullish or bearish, I'll use the one that's lower.
And typically, you got a lot of speed coming out of that model, right? I mean,
Yeah, there's a lot of velocity in those types of runs. It's usually they go down there real quick to get it, take the liquidity, and ramp the other direction. So either get it when it's available. It doesn't hem and haul around. It just like it doesn't hang around for everybody to see something's about to happen. It's just real quick. If you miss it, just don't chase it. Just use the regular breaker.
I love the V-shaped recovery on price when it sweeps liquidity like that. It's like it's the session liquidity or the one set up for life when you get that V-shaped recovery. I love those trades. That speed and just the way it does that, I love it. So Andrew, you're up next. Pippi, I'm gonna keep the conversation going. Great question, Andrew. You've had some good questions in the past. Jump in here, buddy.
Hello, everybody. Hello. So I had a question for Pipman about the 200 and 300 handles she's getting. She said now she has more patience about the trade, like she's waiting for. But I wanted to ask because some of us maybe don't understand, but like what exactly are you looking for and like waiting for right now? Like what exactly are you waiting for to give more? Because from 10 handles to 300, I mean, you have to be looking for something like specifically like a bigger range, you know?
You mean the draw?
Yeah, the drawdown, or yeah, exactly. So what exactly are you targeting to get that huge handles, you know?
Oh, it's the draw liquidity, like Michael always says. You have to you have to have an idea on where price is going. That should be the first thing that you should try to develop and be good at. And so that's actually something that you should always be doing. But the difference is that I wouldn't hold it. So you need that even for 10 handle straight. You need to know where's your draw. What do you think price is most likely going to? What's the most high probability? But I would just get out of the trade. So that's the difference. But it's the exercise is the same. You're supposed to already do that. And well, my TP is not always the terminus. I also like to utilize wicks a lot, so I would also get out at a wick, like at the 50% of a wick. I posted one of those trades as well where I got out at the wick, and I think that one was like 200 handles. And the draw was higher, and if I remember correctly, I had it lined out like this trade to that draw is 500 handles. Um, and I just wanted to get out at that wick, because there's also the element of being content with enough. And I was like, okay, I'm gonna be happy if I get out there with the amount of handles, but also with the precision of the analysis, about getting out at the 50% of a wick. So I'm trying to combine all those things, but the main element is just you have to have your draw, and you have to have that even if you're getting out at 5 or 10 handles.
Okay. So you mean about, I mean, the week where, like Asia range, London range, what exactly, which range are you targeting for the liquidity? Because sometimes my range for liquidity is like 50 handles or maximum 100, you know?
Could
So
I just help real
where do you
quick
choose?
with that? Very, very quick with that, Andrew.
Yeah, sure.
The schematics within core content month 8, projecting daily highs and lows, capturing 70% of the range is really the only schematic that you will find capable of knocking down those kinds of ranges. So what I refer to within that then is you're thinking AMD and PO3, because where and how we are taught through the schematic of month 8 and where and how to capture 70 to 80% of the range is to be capable of identifying the A. And then when you're in the Judas swing, you're looking for the apex of the Judas swing. And then you're looking for the market maker to form through one of 3 entry criterion, the turtle soup, the first stage or the second stage accumulation. So those are what we are looking for very, very specifically within the model of how to
All right,
capture that
okay.
many points. How do you capture a 200-point range? You go back to core content month 8 and you study where and how to capture and understand where a daily range and how the daily range is forming. So where and how price comes out of the 1800, where and how price comes out of the midnight price is then going to leave you with your model, depending on where and how you're engaging with price and that specific profile, for you to look for those ways in which to engage.
All right, okay.
Can
Okay.
I can I
That
ask
makes
can I ask a
sense. All right.
question? Because I hear someone saying, "What are you doing differently that moves you from 10 handles to 200 and 300 handles, and what specifically are you doing that to get that much of an increase?" And I obviously I understand what she went through. She described it, but I think that thank you. I was going to I was going to let the commercial play through. The 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 jump from 10 handles to 200 and 300, whatever you were doing to frame a trade that was incorporating your drill where you're practicing just for a minimum of 10 handles, that's obviously going to have to expand. So whatever you're doing when you're 10 handles is the model you're chasing and pursuing. You have to then adopt a mindset of where am I going to get the range to define why I should even expect 100 handles or 200 or 300 handles. And that's going to be using different time frames, looking at a longer term perspective in terms of where we came from in the past, like what range are we in, how much of the range can we implement going forward and still be within the scope of your skill set. Um, I didn't hear her say, I'm trading 10 handles one day, and then all of a sudden, a week later, I'm at 200 and 300 handles. There's a gap there, and I'm sure it was progressive over time. I don't know what that was, but I didn't jump from like small little moves to big moves. It was a graduated thing where you go from whatever your starting point is to now I'm going to try to double this. And then once I get that and I can be consistent with it, then I'll try to double it again. So we go from 10 handles to 20, from 20 handles to 40, from 40 handles to 80, to 80 to 160, and 320, and 640, and then, going on and on. But it's a graduated thing. And the things that you would do when you were doing it on the smallest scale, which is 10 handles, that cookie cutter approach, you're just applying it to a larger range that should yield you if you stay in the trade long enough. And it's a very uncomfortable thing. It's not fun when you first start doing it. There's a whole lot of you scare yourself many times. You're thinking, I got a really good win here. I've never been here before. I got 80 handles on. I'm trying to get 200. I'm stupid if I hold on to this. I got a feeling it's going to turn against me, and you have to wrestle through that. You got to get through that, and there's no way that you can avoid it There's no other way to learn it. It's just you condition yourself by desensitizing yourself to the outcome. And over time, you start seeing that, oh, yeah, many times I talk myself out of holding the trade because there's nothing technically saying that it was bad. Nothing saying that it was not going to deliver. Everything was saying the other thing. But that's a measure of experience. And in the beginning, when you first start, the first couple of years, you're going to have all of this emotional arguments inside where the rational side of you is going to say, this is a lot of money. Why don't you just take it off? But if you're trying to develop as a better trader and you're training yourself to get better, rewards in your trades and longer term targets and bigger profit margins, you have to condition yourself just like a weightlifter. You have to put more resistance behind the things that you're doing. Otherwise, you're going to stagnate and not grow. There's nothing wrong with being a 10 handle trader if that's what you want to do and you want to invest any more time into it. But to get to 100 handles, 200, 300 handles, 1,000 handle runs, you can't do this one step here, next step there. It's a graduated thing, and it's going to take a lot of time. It's going to be the same model, the same thing that you'd be implementing that makes you bullish or bearish. The same entry mechanism that gets you into the 10 handle trade is the same thing you're going to use when you're applying that range approach to a 60-minute chart. So an hourly chart, when you're using like a 1-minute chart, you can get 10 handles all day long with the 1-minute chart. 15-second chart, you can get 10 trades per hour, easy, on a 15-second chart. 10 handle, 10 handle, 10 back and up and down all day long. You're going to take losing trades more than you probably would if you were trying to do something else. But if it's okay if you're comfortable with that. I'm not comfortable with that. So I want to focus on something that I know is a strong hit. It's less work. I don't have to worry about anything, and it frees up my day. I focus on something that's going to give me a nice range portion of what I think the weekly range is going to be. And I think that if you hear what she was telling you, she just basically applied everything she did before, just submitted the time for a higher time frame, longer draw on liquidity. Nothing needs to change. That's your cookie cutter. Your cookie cutter does not change because you have to make more cookies. It's the same cookie cutter pressed in dough that doesn't run out. As long as the markets are operating, that's the dough. You just take your cookie cutter, press it in, and just keep making cookies. Simple as that.
All right. Thank you so much, Michael. Thank you so much for the explanation. All right, kid. That's it. Thank you so much.
Wonderful, Andrew. Nice having you up. Thanks, buddy. We got Peter coming up next. We heard from Gray Eagle, Andrew. We'll get CKE up here. We'll get Smurf. But Peter, you're up next, buddy.
Hey guys, can you hear me?
Yes, sir.
Awesome, awesome. Yeah, let me first of all, thanks for getting me on the stage and giving me the speaker tag here. I will quickly go through the protocol. So my name is Peter. I'm a German-based trader. I'm trading ICT concepts for roughly 4 years now, and recently I pivoted to take a different approach when it comes to studying Michael's concepts, because since I'm an engineer by education, bachelor's and master's degree. I really want to find comfort into seeing if the models do really have a back-tested performance, and if I can see that, that at least I find out gives me a lot of comfort trading those concepts either manually or automatically. So, and what caught my interest, just to cut really fast to the question I have, the explanation, the whole clinic, Michael, you gave to Gray Eagle Trader and Man. Thanks a lot for that question, and about those dealing ranges and the specific times. For example, you described that in the 2-hour window from 7 to 9, if there is an expansion taking place, a very clear expansion, we should mark it and then project it. And this is just one example, and project it for example, trading the AM session, a 2-hour window from 9:30 to 11:30. So I was curious to just understand, do we need to have, for example, this range, does it need to stay fresh until 9:30, until the AM until the AM session starts. So, for example, if the high and the low from 7 to 9, if they are known, I would assume we are measuring the octants based on the bodies of that range. And does it need to be, or does it need to stay fresh until 9:30? Or is it allowed to, for example, after 9 o'clock to just rate the highs or the lows, and then still we are taking those octants onto the 9:30 to 11:30 trading window? Is that okay, or would you consider um, to have it fresh until 9:30?
All right. I understand the question. It's a really good question. But this is what differentiates what I do versus supply and demand. Supply and demand demands that the levels be fresh. Okay. So it's first time traded to, then it's used. And if it's been used one time, they're not so interested in seeing it again. They want to see a new supply and demand zone. My PD arrays, if you grade out the dealing range properly, they don't have a sell by date. They're always fresh. It's just I have a limitation on how far to look back because I know that the experience level is going to be a deterrent. So I created the PD array look back. It's like there's 20 days, 40 days, 60 days for looking at daily charts. Well, if you just use the time aspect of sessions, okay, don't go back further than 3 sessions. If you're brand new, don't go back further than 3 sessions. 2 is perfect. 1 is enough. And if the range that you were defining, let's say once you grade that out between 7 and 9, but price is just moving higher, and you know what you're looking for. If price comes down, you're going to take a buy. You're long minded. You want to take something long, but it hasn't traded there yet. And say at 9:30, it just goes a little bit higher, but we enter into the lunch hour. What do you think I'm going to be waiting for? I want to see if I'm bullish and it hasn't gone to terminus yet. It's going to create the lunch macro where it pulls down into a low, and it may take one of those PD arrays that was formed during the 7 o'clock to 9 o'clock. And that will be my low entry relative to where I think the draw on liquidity is going to be for my target. So the other side of that is say it uses it during 7 to 9 and it rallies up. But then between 9:30 and 10 o'clock in the first hour's dealing range, it trades back down to it again. But it has yet to hit my terminus where I thought it was going to go in the beginning while I'm bullish. I'm going to use it again. It's a reclaimed PD array. They don't go stale. There's nothing stale in this. It's all fresh. There's no sell by date on them.
Oh man, that's very helpful. Thank you for that. I was assuming it as well because you were talking about that in your lectures a couple of years ago. But for me, it was just because I'm I'm so fired up right now. I'm just opening up the computer and trying to get this logic into an executable backtesting code, and then just run it for the last I don't know 3, 4, 5 years just to see if that holds true. I did that for a couple of your concepts, and I can 100% say that it is true. You can see those effects, especially on the macro times. So yeah, thank you a lot for clarifying that. And I probably will need to listen to that episode today a couple of times. And also for the audience, please check out traderroundup.com. You can get all those episodes and you can listen to them a lot of times. And yeah, it's great. Thank you, Michael. Thank you, Kit,
Great
and
question.
the
Thank
round.
you.
Yeah,
Thank you,
great
man.
question, Peter. Really good question. I love Michael your distinction too. It's they aren't recycled PD arrays. That's good. I like that. They don't have to be fresh. CKE, you're up next, buddy. And then we got Smurf.
Okay, thank you. My name is Chiriot Elkana. I'm from Kenya. I'm new to trading, started March, but at first I'd engaged a content that really misled me. But thanks to ICT content, which has really helped me to learn a lot. The question that I have is there are certain moments, like there's something that I observed this week. When a market, I trade CFD, when a market during a session delivers one-sided, and then it doesn't retrace back to the third, to the fourth or third quadrant, and then the next session, let's say Asian session begins, and then it trades one direction, and then maybe in after 2 or 3 days, it retraces back to, let's say, the New York session on the 50% level of FIB. I really wanted to understand that. And now, when it comes to situations where to go long and short, what are some of the factors in order to help some of the newbies like us? And lastly, I was watching your ICT's content 2024, and there is something that I encountered there. The first thing to look at, that is between 7 to 7:30, is the equal highs or lows that has already occurred between that time. That will be now the next draw on liquidity and helps to determine bias. Those are my few questions.
Okay, the first question you made, I thought I was following along, but it sounds like it's just like a big blow off run that could be news driven or event driven, and that's just missed opportunities. I'm not usually in a hurry to get involved in something like that. I'll just step out of the way. The other questions lead me to ask you: Have you completed the 2016 and 2017 core content playlists?
CKE.
CK, are you there?
I think I've lost you.
No, we can hear you.
I can hear you now. I was asking that did you go through the 2016 and 2017 core content lectures that those two playlists have?
I've only gone through the 2022 model, and I've been following up the series since the beginning of the year.
Okay. A lot of the things that you're asking are going to be easily answered by simply going through those two playlists. Um, the first question, I apologize if I wasn't helpful in that regard, because again, it's not, you don't have a chart and you're just giving me a hypothetical. I don't even know if we're going higher or lower. I don't know what you were describing, but it sounds like a big event driven, like maybe wartime issued type stuff. Like I don't claim to be smart when it comes to that. Things are going to happen, and either it hurt me or I missed it, and it's okay. I can, I'll bounce back one way or the other. So you're not going to have an answer to everything. Sometimes there's price moves that are simply manual intervention, and there's nothing that I can say would have got you in or protected you from it. That's the risks that we all inherently take on when we take trades.
Thank you.
Okay, we
Perfect.
have Smurf up next.
Yeah, we do have Smurf up next.
What's going on, Kit?
Hey, what's going on, buddy?
I'm cool. Michael, how you doing?
I'm doing
All
well,
right,
sir. How are you?
great. So I got a question about OHLC and OLHC and how it correlates with macro. So I give you a perfect example. Friday going into 10 a.m. I wanted Asia lows and London lows because I believe 950 we took out previous day high. We tagged it, right? So my next draw on liquidity was Asia lows and London lows. So can I expect if I've already projected a open high low close candle. Can I expect that the first 10 minutes of the macro should push up above the open price, maybe taking out a 1 minute swing point or a 5 minute swing high, right? So my question is, if it does not happen in that first 10 minutes, what's the next best time to look for that manipulation after that?
Are you referring to NQ?
Yes,
What you're asking, I literally go over in the lecture that I'll be posting in 20 or 30 minutes.
sounds good.
Everything you just asked about, I literally outline it as the catalyst for what I did
Nice,
on
I love
Friday.
that.
nice. So I'm on the right track then,
Yep,
right?
yep, yep. You have all the details. It's all right there for you.
Cool. That's all I need. Thanks. Thanks, guys.
How's that for service?
Yes, sir.
That's great.
We have Market Oracle here.
Yeah, we have.
Hi, Pitman. Hi, Kate. Hi, Michael. Am I interrupting over here?
No, not at all, buddy.
How you all doing?
We're doing great. How about you?
I'm doing really well. So I have a few questions from Michael. The first one is that do we have smaller macros? Like I have noticed, uh, the macros you have told 10 minutes top of the hour and 10 minutes, like the standard 20-minute macros. Apart from that, I have noticed that market has these sudden fluctuations. 5 minutes, like the time is 10:30, so 10:25 to 10:35. This is a smaller macro I have seen perform really well in these markets over. I have noticed it for the last 1 or 2 months. And is this such a thing? Am I doing in the right direction? Am I going in the right direction? I want to ask this question.
First and foremost, that's not a macro. Macros are 20-minute intervals, last 10 minutes at the top of the hour, first 10 minutes of the new hour, and the macros that are in the last final hour of regular trading hours. So there's four of them in that last hour. But what you're describing, you're just seeing the effects of the first hour's dealing range. So from 9:30 to 10:30, things start getting animated because there's a lot of algorithmic models that are used institutionally that demand that there be a first hour of trading before they do anything. And that's why when you see these people talk about orbs like opening range breakout, some of them are 5 minutes, some of them are 15 minutes. It's laughable. You can make money. I'm not saying you can't make money, but you're so close to the trees you can't see the forest. So the algorithm runs on the first 30 minutes. That's just the bottom line. But then you have the first hour's dealing range. So what you described was from 10:30, 10:35, you're seeing this little flurry of activity. It's because they're generating liquidity and exchanging of orders because of that fact that first hour has now been booked. So now you're seeing the first 5 minutes after first hour's trading. So no, it's not a macro. It's just there's an increased participation, and that fluctuation is going to reflect that because they know there's a flood of. Just study it on your own. Everybody that's listening to it, just see how much of an interest. Maybe it's a price run that's already going. It's a little bit of flurry of continuation there, or if it's a short term little low, it'll create a little flurry. It'll pull back into the range a little bit. It's only because there's more activity coming in, and it's after the first hour's dealing range completes at 10:30 Eastern time.
Well, I was thinking these things happen in a London session as well, like 325 to 335, 425 to 435, and these work well in uh, pre-market session like 725 to 735. There is a flurry of a sudden price movement, just like we see in the macro, but on a smaller scale than those 20-minute intervals.
I'm going to say it again. That's not a macro. You're just seeing an increased volatility. I promise you, I'm not hiding it from you. There's no other macros.
Thank you, sir. And I have another question as well. Like uh, a few weeks ago, you taught us about the grids, time grid and price grid. So my question is that do we grade the 24-hour periods into quadrants as well, quadrants or octants, so that we have a proper matrix type? Is this something that you do divide the time into quadrants as well?
The full daily ranges?
Yes, sir. Daily range or weekly range
Absolutely.
divided it into.
Absolutely, I do. Yes, absolutely. One of the things I taught behind the paywall, and Pippi Banks, if he's here, he'll tell you he heard me teaching it there too. If we're bearish, okay, and the market's really bearish and really wants to continuously go lower, if you look for today's selling, okay, your best sells are going to form in the lower half of yesterday's range. So how would you determine that if you aren't grading yesterday's high and low? So what are you doing there? Same logic today. It's not me reinventing new stuff. Behind the paywall, I taught charter members and paid members as they were going through the motions of learning from the paid side of it. The support of the upper half when you're bullish and the resistance of the lower half when you're bearish. Same element just being applied to the full daily range. That's a fractal mentality. It's a very specific mechanism that you're applying to specific ranges. When you apply it to time, you'll be able to determine, okay, what's the range inside of this time window I'm looking at? It's the discernible, clear little period that makes a nice little trending movement. Everything else around it is irrelevant. You're looking for that little clear cut piece. Well, what is a daily range? It's a clear cut piece of price action. It's a very discernible high and low of a range. So, yes, I absolutely do that for the weekly chart. I absolutely do it for a daily chart. I do it for the last 3 days. Oops.
I don't think I could frame the question correctly. Yes, I understand about the quadrants and octants that you measure ranges of price, but I am talking about the ranges of time. Like we have 24 hours in a day. Do we divide it into octants and use this like it would be a 3 hour intervals? And what specifically happens at that time? Like we start, it would be
Yeah,
6
yeah.
p.m.
I know what you're
9.
saying. It's almost like you're trying to do Fibonacci on time. I don't do anything with that. I have no nothing. I don't do anything with that now. As far as time, I've literally placed everything in your hands that I'm going to as it relates to time. There's very specific little windows of opportunity. You just look for the defined range that forms in there and then grade that out. You will see all the nice price runs, unless it's manual intervention. Price runs will run off of those types of things I'm teaching. Very rarely will you find something that surprises you because it's going to use this information. It's going to use these key PD arrays that you can see that are graded out based on a dealing range that either is going to continue once it trades back up into it or down into it, or it will reverse once it leaves it and comes back in and treats it as an inversion aspect. So I don't have anything that I'm secretly hiding or even implementing. I don't even believe in Fibonacci on time. Like I don't believe in it because, frankly, if I could do it, I'd be in a lot of trouble because I'd be arm wrestling God, saying I don't want to teach that because to me that would be absolutely like perfect knowing the future. Then I spent a lot of time investing in things and trying to pursue that in prayer, in testing things and doing this and doing that. I never found anything that was consistent with it in regards to implementing a very specific measurement, projecting time. Larry Williams has a book. I think everybody should have it in their library. How I Made $1 Million Trading Commodities Last Year, and there's a little paragraph section in that book, and he calls it his 1.28 formula. And I didn't know about it from the book. I learned about it first from his 4-tape VHS series, and he talked about it. And of course, now, mind you, I'm 20 years old. I'm very impressionable. I'm looking up to this guy because he did something nobody else had done, and I'm like, he's real. Like he's real. He did it. So he sits there on this overhead projector in this little video course. He says, "Okay, this is something that I like to use. And what you want to do is you want to take the highest high over here and the next high, and then find a low in here, and then measure how many count the days or the bars between it, multiply it by 1.28, and project it from the low in between. And usually you'll get some kind of a turnaround right there. Or sometimes if it's a trending move, it'll really start to accelerate there." And in my mind, as a 20-year-old, I heard this guy knows how to predict the next high and the low, and I believed it because he said so. So I understand when people, and I'm going to say this, and it's not because I want it, but they literally worship the ICT persona because they think I'm God down here, and I'm not. I had that same feeling towards Larry Williams. Like this guy had things I didn't even think was possible, and I put all kinds of, I guess, belief and faith in this 1.28 because I was like, he's showing examples of it. Look, it's calling the very candlestick. Like, come on, man! Like this is it. I can't believe I only paid $300 or less to get these 4 days. I can't believe it. And then I tried to trade it with copper, and man, I don't know what happened. It's like they said, "Oh, today it no longer works because it raged against me and I got hurt." So then I tried it again in another grain market, got hurt. I was like, okay, I can't touch it. So I played around with it, in back testing and stuff, and discovered that it wasn't as sound. And I learned my lesson. I didn't back test it enough to see it's not that great of a thing. But packaging something making it sound wonderful is altogether something different until you put it in your own hands. So that was my first foray with the elements of time and like projecting things in the future and all this other stuff. It sounds wonderful. It sounds really neat and mystical. And I bought into it. I was like, this is really cool. Sometimes it works and sometimes it didn't. And I had some things that I coded. And when I had Supercharts, which is an old platform, and then TradeStation, when I was using Easy Language there, I put some things in there. It would kind of like overlap other things I had. And sometimes it would be like one or two candles away from the thing I'm trying to aim for a long or a short. But it was so infrequent. It's laughable to even consider it being used. So I don't like the Fibonacci element of time. There's wonderful things that we can talk about in hindsight and show, and there's books written out there, and they try to sell the idea. But why aren't these people just not writing books anymore? Like, why aren't they just being rich? Because if they know the future and they know when it's going to do that, like, you figured out the only piece that I could never figure out. That's what everybody wants to know. When is the actual candle to get in? Because wouldn't that answer everything? Because I'm telling you what range to focus on, what level it's going to create the thing on. So now if you can figure out the actual time, then that's it. We're all billionaires. We're all putting welfare checks, in Elon's pockets now because he can't keep up with us. That's what it's going to be like. But obviously the reality is that it can't be like that at all. Nobody knows that. Nobody knows that. So I learned the hard way. I lost lots of money trying to do things with projections and Fibonacci with time, and I found that the business operates on business hours. There's certain windows of opportunity. They make concession for London traders. They make concession for Asian traders. They make concession for AM New York traders. They make concession for people during the lunch hours. They make concession for the PM session. And that's it. That's all you get to worry about. Like, there's nothing else about time that you need to worry about. They bring in the macros and you got it. It's on lockdown now. But you have to know where it's going and you have to know what price. And then that's the part that a little bit of skill requires. There it is. You don't need all this other, pseudoscience of Fibonacci on time. I don't break anything down with time except for what I already taught you. It's look inside this little window. When price gives you a range, just map that out, project it forward, and wait for price to utilize it. And then if you got the draw right, you got a winning trade.
Thank you so much, Michael. I have two more questions if I'm allowed to ask.
Let's go with one because I only have a little bit of time left. I want to see if anybody else has something else.
Okay, sir. So the things you have taught about power of three AMD, we divide the price trend into three categories: accumulation, manipulation, and distribution. But when we grade ranges, we divide it into four, like quadrants or octants. So I was asked, my question is that why didn't we, or why did you not go with three? Or I certainly know there is a benefit of four, but and eight. But this question was in my mind, like, why didn't we go with three? Because there are three stages of any price run.
You have to define something in terms of equilibrium. So where there's equilibrium, you have to define where premium to discount is going to be, what range that's going to be, and then this mystical that doesn't really exist algorithm has to be able to map out very specific price levels that it would refer back to. So the easiest way to do that is in grading it for quadrants, eighths, sixteenths, 30-seconds, so on forth, if the range permits that. If it's a usable range, you can define it down to that low. But just thirds, it's just a simple, it was me giving you how I arrived at this information. It starts in the earliest journal. Everything I'm teaching, we're in the latter portions of my journals. So it starts very infantile in the beginning. But then we start getting a little bit more information, and I learned more things and more refinement, more refinement, more refinement. So if you look at old stuff, it's not recognizable. But it's just a graduated movement from where I knew nothing and going through the early stages of